In this episode, we'll look into the Fed, we'll assess Jerome Powell's speech, and how it impacted the markets. We won't rely on news sources, we'll go directly to his testimony. Then we'll see how the mainstream media news commented on Jerome Powell's speech. What the Fed does is very important to global markets, and you need to know what it means. Let's run the numbers. Hi everyone, I'm Ken from CryptoTradingKS. My goal is to share my 30 plus years in financial markets to help you to become more of a financial blessing to yourself and those you love, gaining real wealth and positive excellence in the process. If you're new, a very warm welcome and welcome back KS family. And please note, I don't have WhatsApp or Telegram. Let's run the numbers. Bitcoin is currently down 0.83% to 22,200. Ethereum is down 0.6% to 1557. In the last trading session, we can see the global markets started to turn red. On the back of Jerome Powell's testimony, the markets sold off, and you can see each and every sector was down. The majority of stocks in the main market were also down. We saw a slight increase in the VIX, and the major market indices were all down over 1%. We pay attention to what the mainstream media news says, but we don't take their word for it. We check the sources. I'm going to quickly go through the statement by Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. What we see Jerome saying is the full effects of our tightening so far are yet to be felt. Inflationary pressures are running higher than expected and remain well above the FOMC's long-range objective target of 2%. What we see is Jerome Powell and the Fed focusing on core services. They need this component to come down until they see lower inflation in that sector, which accounts for more than 50% of core consumer expenditures. They're not going to put their foot off the gas. They're going to increase rates. What else did Jerome say? He said that despite the slowdown in growth, the labor market remains extremely tight, with 1.9 job openings for each unemployed individual, close to all-time peak records. And also, unemployment insurance claims have remained near historical lows. The labor market is very, very tight at the moment. It's very strong. We monitor what the Fed does each and every day through our projections. I'll show you what we look at. We can see that the next FOMC meeting is in a little over 2 weeks away. We can see 1 month ago the probability of a 50 basis point increase in the federal funds rate was just 9.2%. Today it's a staggering 66.1%. And we could see that even yesterday it was 31.4%. Now, what has this done to the market? It's done very, very specific things. To be a professional investor or professional trader, you must understand how the macroeconomic picture can and possibly will impact the markets. Because if you don't understand this, you'll continuously get caught on the wrong side of the trade, and you will not know why. Shocks always happen, and that's just part of life. But the real key is to be in a position where you understand what actually happens, and you can predict how knock-on effects actually occur. And we're going to show you and go through quite a few things. With the increase in the federal funds rate, you should already know that the DXY will have spiked. And you should also know that when the DXY spikes, that means that markets come under pressure. Let's get back to Jerome Powell's testimony. Jerome says, "We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate." And we can see that reflected in the market statistics. Unfortunately, a lot of people think that as soon as a government does something, it's immediately reflected inside the economic system. This is not the case. Things can take months or even years to play out. And Jerome says it will take time, however, for the full effects of monetary restraint, that means the increases in interest rates, to be realized, especially on inflation. He's basically saying the market has not priced in the Fed's activities. He adds the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. What does he mean by bumpy? Basically, he means that the impact of the increases in interest rates will be over-assessed and under-assessed by the market, and that creates massive opportunities for trading. Jerome Powell also cleared up something that was quite important. He said, as I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. That's why he would be prepared to increase the pace of rate hikes. And why is Jerome Powell doing this? They want to bring the target rate of inflation back to 2%. To restore price stability requires maximum employment and stable prices. You've read the gloss, now let's run the numbers. As Jerome Powell said, actual inflation is much larger than anticipated. Masterclass students, please check your chart in TM4. Having been in financial markets for more than 3 decades, I don't take much attention to what the press and news media tell us. They'll use the same concept to explain why the markets go up one day and why they go down the next. It's very confusing. So let's get rid of the confusion and look at the source data. Very quickly, we can see that the CPI remains in an upward trend. Annualized inflation is coming down. It's decreasing, but it's decreasing at a decreasing rate. But what we actually notice here is the 5-year break-even inflation rate, the 10-year break-even inflation rate continue to rally up. And the 5-year forward inflation expectation rate is also going in the wrong direction. It's because of this that the Fed is talking about higher percentage increases in the federal funds rate. What is that doing to the market? Just recently, of course, with Jerome Powell's testimony, it's actually a bit of a dampener, and we can see that Bitcoin has broken a level of support here. And we can also see, when we look at the Fed balance sheet, that tightening, that taking money out of the system is actually working. M1 and M2 have both come down. There was a bit of a divergence between M1 and M2, but now M2 has pretty much caught up to M1. M1 is just freely available cash. M2 is a little bit more than that, includes savings. But we can see the savings rates are going down. They look to be turning the corner, but this is economic data. It can change in a heartbeat. And that's why we need to be very, very flexible as well. Looking at the main markets in the past trading session, we can see the VIX started to come up. But you can see also that the VIX hasn't even gotten going yet. We've seen the VIX come down for a very, very long time. And I do deep dive explanations in TM6. What you actually see is the VIX has been coming down for a considerable period of time. This actually places the pressure off markets. It restores enthusiasm back into the market. But when the VIX spikes, the markets come down. Please be aware of this. One thing that we note, the DXY absolutely rallied. It smashed through. And this is important to understand. Macroeconomic factors can shift the markets very, very quickly. What did that do to gold? Real rates were absolutely hit, and the DXY and gold have a very acrimonious relationship with each other. That means that they tend to fight with each other. If the DXY goes up, gold comes down. Not always, but generally. And if gold is going up, the DXY is coming down. You can see that playing out fairly accurately here. A lot of people say it must become a rule, it must become a law. If the DXY goes down, gold must go up. Don't get sucked into retail thinking. Financial markets are not so simplistic. We can see, of course, that yields came up and bond prices started to retrace. Oil could be very negatively affected by this news. If rates increase, if a recession is put on the cards, and recessions are always on the cards, a lot of retail investors, people that are new to the market, they look at a recession and say, oh no, a recession, I must get out of the market, I must stop all investment. There's a thing called the business cycle, and the business cycle is always boom and bust. You just know how to deal with it. You can't escape it. It's part of the economic system. One thing that we need to pay particular attention to is that junk bonds and high-yield corporate bonds also retraced, and we would anticipate that. But if they actually retrace under a level of support, we would anticipate that the DXY is coming up strongly, that the VIX is spiking, that gold is plummeting, and the markets are retracing very, very badly. Keep your eye on junk bonds and high-yield corporate bonds, and we'll do that each and every day. Expect a lot of negativity to get into the news headlines. A lot of people will be talking about the party is over, the Fed has killed the stock market, and if it's killing the stock market, it's killing crypto at the same time. Why do we say that? We say that because of Rule 225. Bitcoin cannot escape the stock market's gravity. If the stock market is under duress, Bitcoin will be under duress. And you might say, Ken, I don't care if Bitcoin is under duress. I don't even buy Bitcoin. I buy my meme coins, or I buy other tokens. Well, we've got a rule for that too. It's Rule 45. No alt can escape Bitcoin's gravity. Your alt's fate is tied to Bitcoin. And you might say, but Ken, I'm not even in Bitcoin. Bitcoin is a scam. Bitcoin is a Ponzi. I'm not in it. I'm in a different market, and I'm not in the US market. I don't have to worry. There's also a rule for that. It's Rule 217. No stock market can escape the US's gravity. Pay a lot of attention to what the US is doing. If you don't, you're going to get smashed. Getting back to the S&P 500. If the S&P 500 loses this support, where is it going? Most people will say it's going to nosedive down like this. It's going to be a 60% reduction. It's all over. Because they think that price doesn't move in a wave. It just drops or explodes. Crypto can implode or explode, but the stock market doesn't do that. It's always going in a wave. Even when we got a sell-off, it's going in a wave, up and down. And if you're on the right side of the percentage, you can make money at any stage inside the market. If you're marking up your charts with the CTKS method, you already know the answer to this question. If we look at the S&P 500, of course, it was basically obliterated when Jerome Powell came out and said, rates higher for longer. But a lot of professionals already knew this. The real key is, where is the actual support in the S&P 500? A lot of people would not actually know where it is, because through the CTKS method, you need to analyze all of price history, not just recent price history. Recent price history will RIP your funds because it's recent indicative price. It's a professional no-no. Therefore, turning on our X-ray vision by applying the CTKS method to the S&P 500, we can see that the S&P 500 is currently trading at 39.88. It has a very strong smart money buy area below it from 38.78 to 39.88. Keep this in mind. If we actually break through this area, I would suggest that we could be in a lot of trouble. But if you already know the CTKS method and you've applied it to the S&P 500, you'll already know how strong that area is. A lot of people will be saying the markets are going to tank. Not if they don't trade below 38.78. They are not. If you're investing and trading, or investing or trading, and you don't know the CTKS method, you're going to suffer a lot of sleepless nights. Instead, get X-ray vision and learn how to do this yourself. When the FOMC says we need to raise rates, what happens to the DXY? It goes up. And we can see that the DXY really went for it. But there is an underpinning structure inside the DXY. Let's turn on our X-ray vision through the CTKS method. If you've been applying the CTKS method to the DXY, you already know that the DXY just hit a major structural sell level. Currently, the DXY is around 105.564. You can see that there's a smart money sell level between 105.570 and 105.795. There's a very strong structural sell level inside that band. Students of the CTKS method know not all bands are equally weighted. Some bands are much stronger than others. If you want to have more sleep-filled nights and less sleepless nights, use the CTKS method to mark up your charts. Thank you to the people who reached out and requested a chart to be marked up through the chart markup request form. Each and every day, 7 days a week, Kate and I are here to help you out. Many people wanted an analysis of a specific asset class. I'll show you what it was. People absolutely love the euro versus the US dollar. We can see that when the euro actually broke this smart money buy area, there was an air gap in between, so it plummeted down to the next series of smart money buy areas. One thing that is pretty much not apparent by this chart, but is apparent to anybody who has studied the CTKS method, the real area of support is between 105.238 and 105.388. That's where the real structure is inside the market. We've got shorter term structures coming through here, but the real structure is around there. Please bear this in mind. The euro is currently trading at around the 1.0555 level. The other thing that you'll notice is all of these charts are interdependent and intercorrelated. The DXY moved in the opposite direction of the euro to the US dollar. And you may say, Ken, of course it did. But if you understand Forex, you would know that. But a lot of people don't understand Forex. If you would like me to mark up specific charts, just go to this URL. You can just pop it in. There's some questions there, and they will help me to help you. And that's why I'm here. That's why Kate is here. We want you to be more of a financial blessing to yourself and those you love. And the way you get there is through knowledge and mindset. We saw that when the DXY just rallied, the euro just plummeted, and gold plummeted as well. We know that the DXY is really literally at a strong structural sell level. The euro is coming close to a strong structural buy level. And when it comes to gold, if you know the CTKS method and you've applied it, you'll also know that gold is just literally touching some very strong structural buy levels. Please keep this in mind. Gold is currently trading at 1814. What a lot of retail do is they analyze a particular chart that looks like this, and they say, well, the resistance is here, the support is here. Just pretend that you can't see forward price action. That's not the way to do it. Gold has been trading since 1883. You need to mark up your chart from that date. So when I mention a very strong structural support, those structural supports are including all of price action, not just recent. Also, gold can disconnect from the DXY. We've seen recently China and Russia tension with the US. Gold is often seen as a flight to safety, and we can see China is becoming increasingly aggressive with the US. If China invades Taiwan, it will be to take over the high-end chip manufacturing sector. This will play out on the entire global economy that's increasingly turning towards AI. Having dealt with government officials at the highest level for many years, there is the reported story and there's the real story. Don't get confused, the two are not the same. As professionals, we do our three-dimensional risk management code every single day because we know the markets are always moving in a wave and they're always volatile. We know that we control the trade or investment, but it's the market that controls the return, and we cannot force the market to give us a return. The market will give us whatever it wants to give us. Your returns are always based on your synchronization with the market. If you're desynchronized, you'll be making losses. If you're synchronized, you will be making profits. The market exists to transfer funds from the desynchronized to the synchronized. How do you get synchronized? Well, you need to know what you're doing. To get synchronized, you must have the knowledge. You must understand how different things correlate and decorrelate with each other. You must look for consistently reliable signals. You must uncover the rules of the market. That's part of it, but you also must have the right mindset. We've done a deep dive on the Fed Jerome Powell's testimony, and that means we've pretty much run out of time to look at crypto. That will be in the next video. If you're only in the stock market, you must realistically know about crypto. It's the same if you're only in the stock market and you don't know about the bond market and you don't know about Forex. That's a gap in your knowledge. The market will reward your active learning, and the more you know, the more you make. The crypto video will come out after this one, episode 830. I would urge you to actually reach out to me and tell me what you would like to see marked up with the CTKS method. The CTKS method is a standards-based process to reveal smart money buy and sell levels from any price chart, and it can be applied and is applied to stocks, crypto, futures, forex, commodities, and any other price chart. The form is there. Please just pop onto that right now and let me know what is important to you so I can look after you better. Have a great day or night ahead, my friends, and keep on reading the CTKS Creed each and every day. It's powerful. Take care out there, and Kate and I look forward to catching up with you tomorrow. Bye for now.